There's a growing fear across the financial world that President Trump may try to take control of the Federal Reserve, raising concerns about the Fed's independence and the future of U.S. monetary policy. Why does this matter to everyday Americans? Because decisions made at the Federal Reserve directly influence your mortgage rates, credit card bills, retirement savings, and even the buying power of your Social Security checks. When the Fed adjusts interest rates or prints money, it changes the cost of living for tens of millions of families across the nation. For those on fixed incomes, like retirees depending on Social Security or veterans receiving benefits, this fight over the Fed is not an abstract policy debate. It determines whether your benefits keep pace with inflation, whether the dollar you spend at the grocery store buys the same amount of food, and whether your savings lose or gain value over time. That's why we need to break down exactly what the Federal Reserve is, how Trump is trying to reshape it, and what it could mean for Americans going into 2026. Many Americans assume the Federal Reserve is a government agency, but in reality, its structure is more complicated. The Fed is made up of 12 regional banks across the country, each structured like a private corporation. Member banks, commercial banks you and I use every day, hold shares in these reserve banks and are legally entitled to dividends. While the Fed's Board of Governors is appointed by the President and confirmed by the Senate, its regional banks remain tied to private ownership, giving the financial industry a powerful role in shaping U.S. monetary policy. This independence was intentional, designed to insulate monetary decisions from short-term politics. However, it also means unelected bankers and financial institutions exert significant influence over interest rates, money supply, and credit availability. For everyday Americans, this has real consequences. When the Fed raises rates, it makes mortgages, car loans, and credit cards more expensive. When it cuts rates, it can encourage borrowing, but also fuel inflation that erodes Social Security checks and retirement savings. Millions of Americans are caught in the middle of this delicate balancing act. President Trump has long favored lower interest rates, pushing the Fed to slash rates from 4.5% to around 1.5%. His argument is simple. Cheaper borrowing stimulates economic growth, boosts jobs, and lowers the federal government's interest payments on its record national debt of more than $34 trillion. In theory, this could give businesses more room to invest and families more access to affordable loans. But the flip side is equally important. If rates are cut too aggressively, it risks igniting inflation at a time when many Americans already feel squeezed. For seniors living on Social Security, inflation can be devastating. Even though benefits adjust through COLA, the increases often lag behind real-world costs like housing, healthcare, and food. If Trump's vision wins out, millions of Americans could see short-term borrowing costs go down, but long-term price increases may eat away at fixed incomes, making it harder for retirees and working-class families to get by. In September 2025, the Fed did cut rates, but only modestly, from 4.5% to 4.25%. More importantly, the Fed laid out a cautious plan, projecting rates to slowly fall to about 3.0 to 3.25% by the end of 2028. This deliberate timeline shows that Fed leaders prioritize steady inflation control over rapid political demands. Trump, however, viewed this as far too slow, fueling his push for deeper and faster cuts. For millions of households, this tension reveals the trade-off at the heart of monetary policy. A slow rate-cutting path may frustrate borrowers hoping for cheaper loans, but it helps protect seniors and families from runaway inflation. If inflation spikes again due to drastic cuts, the COLA adjustments to Social Security may not be enough to protect beneficiaries. Seniors may find themselves choosing between paying medical bills, buying groceries, or covering rent, even as stock markets rally for wealthier Americans. Trump has already begun reshaping the Fed by appointing his economic advisor, Stephen Moran, to replace Adriana Kugler, a Biden appointee who resigned. Moran immediately pushed for a steeper 0.5% rate cut rather than the smaller 0.25% the Fed approved. At the same time, Trump has targeted another Fed board member, Lisa Cook, with allegations of mortgage fraud. Courts blocked her removal, but the case is now at the Supreme Court, showing Trump's willingness to fight aggressively for control. The biggest turning point will come in May 2026, when current Fed Chair Jerome Powell's term expires. Trump is expected to replace him with a loyalist, giving him overwhelming influence over monetary policy. For millions of Americans, this could mean an abrupt shift in the Fed's direction. With a Trump-appointed chair, aggressive rate cuts and looser monetary policy could become the norm. That could fuel stock market growth, helping wealthy investors, but it could also raise inflation, hurting retirees, low-income families, and anyone relying on fixed Social Security benefits. Critics of the Fed argue that it is unconstitutional, pointing to Article 1, Section 8 of the Constitution, which grants Congress, not a private banking system, the authority to control money. The Founding Fathers, including Thomas Jefferson and James Madison, were deeply skeptical of central banks. Jefferson warned that giving a central bank power to issue money would erode liberty and fuel inflation, while Madison emphasized that monetary control should stay in the hands of the people's representatives. Supporters of Trump's view argue that dismantling or weakening the Fed could restore democratic accountability, but removing the Fed's independence could also open the door to politically motivated decision-making that destabilizes markets and weakens global confidence in the U.S. dollar. For everyday Americans, both paths carry risks. If the Fed remains unchecked, it can make decisions that favor Wall Street over Main Street. But if political leaders dominate the Fed, inflation and reckless money policies could devastate retirees, wage earners, and working families. If Trump gains control over the Fed by 2026, aggressive rate cuts and renewed money printing are likely. This could temporarily boost the economy, making credit cheaper and lifting asset prices like stocks and real estate. Wealthier Americans with investments may benefit, but those living paycheck to paycheck could see higher prices for rent, food, and medical care. Seniors on fixed Social Security incomes would face a direct hit as inflation eats away at every dollar they receive. The ripple effects extend beyond U.S. borders. Rapid money printing could accelerate global de-dollarization as countries move away from the U.S. dollar in trade. If confidence in the dollar weakens, it could drive prices for imports even higher, further straining American families. Millions of retirees and Social Security recipients would be especially vulnerable because their benefits rarely rise fast enough to match sharp cost increases. Aggressive monetary easing could widen the wealth gap, benefiting asset holders while leaving behind retirees, low-income households, and working families. We've already seen how inflation disproportionately hurts those on fixed incomes. Groceries, housing, and healthcare become more expensive, while wages and benefits lag. For 66 million Americans on Social Security, this widening gap could mean growing hardship and reduced quality of life. History shows that when economic inequality grows unchecked, it often fuels frustration, unrest, and even instability. If the Federal Reserve loses independence and becomes a political tool, decisions may serve short-term political gains instead of long-term economic health. That could leave millions of Americans caught in the crossfire, watching their savings erode and their Social Security checks buy less and less over time. So, where does this leave us? President Trump's attempt to reshape the Federal Reserve could bring cheaper borrowing and a short-term economic boost, but it also risks accelerating inflation and deepening inequality. For Social Security recipients, retirees, and low-income families, this battle isn't about politics, it's about whether your monthly check will cover your basic needs in the years ahead. I want to hear from you. Should the Federal Reserve stay independent, or should leaders like Trump have more control? Do you think aggressive rate cuts will help or hurt people on Social Security in 2026? Drop your answers in the comments. I'll cover them in upcoming videos. Please like this video, subscribe to Social Security Post, and share your questions about Social Security, SNAP, Medicaid, or Medicare so we can keep this conversation going.